Picture this moment. You're setting up your long-term plan. You know you want broad market exposure at low cost, and two options stare back at you: an exchange-traded fund and an index mutual fund that track the same benchmark. They look identical on the surface, but your day-to-day experience and your long-term results can feel very different depending on which wrapper you choose. This walkthrough gives you the practical differences that matter for costs, access, control, taxes, and behavior, so you can pick a default that fits your U.S. accounts and your contribution routine. Start with the simplest truth. ETFs and mutual funds are wrappers, not strategies. Both can be passive or active. Both can track the S&P 500 or a total market index. Before costs and frictions, two funds tracking the same index should deliver very similar returns over time. The difference you'll actually live with is how you trade them, how they handle investor money flows under the hood, what that implies for taxes, and how easy they make your plan to automate without second guessing. Here's the plain English split. An ETF is a basket of securities you buy and sell on an exchange during market hours, just like a stock, using a ticker. You can see quotes in real time, place market or limit orders, and execute at prices that move all day. An index mutual fund takes orders during the day, but processes all of them after the market close at a single net asset value. That end-of-day pricing removes the need to think about intraday execution, which some investors prefer, especially if fewer decisions keep them on track. Under the hood is where taxes and trading efficiency come from. ETFs are built around a creation and redemption mechanism involving large institutions called authorized participants. When ETF demand rises, these participants can deliver a basket of the underlying securities to the fund in exchange for new ETF shares, creation. When investors sell heavily, participants can redeem ETF shares for the underlying securities, redemption. Because these exchanges are typically done in kind, the ETF may be able to meet flows without selling holdings for cash, which often reduces taxable capital gains distributed to all shareholders. Mutual funds, by contrast, meet redemptions by selling securities to raise cash, and those sales can realize gains that are passed through to every shareholder, even those who didn't sell. You still owe tax on your dividends, and you'll owe capital gains if you sell at a profit in a taxable account, but the ETF's plumbing often leads to fewer taxable distributions over time. Intraday trading brings convenience and a few responsibilities. With ETFs, price discovery and execution happen all day, which means you can use limit orders to control your fill price. You'll see a bid-ask spread that acts like a small, variable cost, and you may occasionally notice the ETF's market price trade at a slight premium or discount to its underlying value. Spreads are typically tight for large, broad market ETFs and widen for smaller funds with less liquid underlying holdings, or during volatile markets. Practical trading hygiene helps a lot. Prefer limit orders, avoid the first and last few minutes of the session when spreads can be wider, and check typical spreads before placing large orders. Mutual funds sidestep all of that with end-of-day NAV execution. You won't control the exact price, but you also won't worry about spreads or timing the clock. Costs deserve a full look because small differences compound. Both wrappers can be very low cost for broad, passive exposure, but the cost stack differs. For ETFs, add the expense ratio to the average spread you'll pay on buys and sells, plus any platform fees your broker charges. Many brokers have zero commissions for ETFs now, which puts the focus on expense ratio, spreads, and how consistently the fund tracks its index after fees. For mutual funds, watch the expense ratio. Look out for any sales loads or 12-by-1 distribution fees still lingering in legacy share classes, and confirm your plan or platform doesn't add extra layers of charges. Minimums and automation are where convenience can flip your default. ETFs generally have no minimum beyond one share, and many platforms now offer fractional shares, which makes ETF-based dollar cost averaging simple at any contribution size. You can set recurring transfers and recurring buys on a schedule that matches payday so the plan runs without attention. Mutual funds sometimes have higher minimums at the fund level, but often shine in workplace plans where end-of-day auto-invest is native and routing paycheck deferrals directly into a plan's index mutual fund requires almost no maintenance. In employer plans, menus often lean heavily toward mutual funds. Some plans offer an optional brokerage window for ETFs, but that can add complexity and sometimes extra costs. In IRAs and Roth IRAs, both wrappers are typically available with zero commissions, so you can choose based on taxes, automation preferences, and order control. In taxable accounts, ETF tax efficiency is often compelling for buy and hold investors. Let's talk taxes in practice. If you hold a broad ETF in a taxable account for years, the in-kind redemption mechanism and generally low turnover can reduce the number and size of capital gains distributions you receive each year, leaving more return compounding inside the fund until you sell. Dividends still flow and are taxable annually. When you eventually sell shares at a profit, you'll realize a capital gain, just as you would with a mutual fund. With mutual funds, even if you hold and don't sell, the fund's internal trades to meet redemptions or rebalance can create gains that are distributed to you annually, which can drag on after-tax returns in a rising market. In tax-advantaged accounts like traditional and Roth IRAs and 401ks, those differences matter less day to day, because gains are either deferred or, in the case of Roth accounts, potentially tax-free on qualified withdrawal, so wrapper choice there can lean more on costs and convenience. Liquidity can be subtle. An ETF's on-screen volume isn't the only measure of liquidity. The liquidity of its underlying holdings matters because it influences spreads and the ease with which authorized participants can create or redeem shares. Large, broad ETFs tracking major indexes usually enjoy deep liquidity and tight spreads. More specialized ETFs, those focused on narrow sectors or illiquid bonds, can see wider spreads and bigger premiums divided by discounts during stress. This doesn't make them bad, but it does make order discipline more important. Mutual funds remove intraday liquidity decisions by design, which can be a behavioral advantage for investors who prefer fewer levers to pull. Active management exists in both wrappers. There are active ETFs now, not just passive ones. If you're considering active strategies, evaluate the same fundamentals regardless of wrapper: process clarity, fees, tax profile, trading costs, and whether the strategy's edge is plausible and persistent. The wrapper won't turn a poor process into a good one, but costs and tax handling can tilt after-tax outcomes between two similar active approaches. When two funds track the same index, judge them by tracking difference, the net performance gap between the fund and its benchmark over time, and the volatility of that gap. Lower expense ratios, efficient replication, full replication for simple indexes, well-executed sampling for complex ones, and disciplined cash management help keep that difference tight. For ETFs, stable, tight spreads also help, because they reduce the friction you pay going in and out. Here's a simple, lived example. Say you want S&P 500 exposure. You compare a broad, low-cost S&P 500 ETF to a broad, low-cost S&P 500 index mutual fund in a taxable account. Before costs, they should match. After costs and taxes, the ETF often has the edge because it may distribute fewer capital gains annually, and its expense ratio can be similar or lower. If you expect to add money monthly in small amounts, fractional ETF shares make it easy to keep your cadence consistent. If you're inside a 401k with a great S&P 500 index mutual fund and no ETF brokerage window, the mutual fund's end-of-day auto-invest is the path of least resistance, and that behavioral simplicity is powerful. To estimate your own total cost of ownership, add the annual expense ratio to an estimate of spread cost per trade multiplied by how often you trade. Then consider any platform fees. If you trade infrequently and hold for years, the expense ratio dominates. If you trade monthly, spreads are relevant, but with broad ETFs, they're often a few basis points, still small compared to the benefit of staying invested. For mutual funds, focus on expense ratio and any loads or distribution fees. In many modern index funds, there are none, but it's worth checking share classes and plan documents. The wrapper you choose should also protect you from yourself. Intraday access is a feature, not a mandate. If seeing live prices will tempt you to tinker, lean toward fewer decisions, either by using mutual funds where appropriate or by adopting strict rules for ETF trading. All buys as scheduled limit orders near the midpoint, no gut feel sales outside of planned rebalancing, and a 24-hour cooling off rule before making changes. If the simplicity of end-of-day execution keeps you calmer and more consistent, that simplicity might be worth more than a few basis points of theoretical advantage elsewhere. Now, turn this into a durable decision you can apply on autopilot. If you value intraday control, want low or no minimums, care about after-tax efficiency in a taxable account, and are comfortable placing limit orders, default to broad, low-cost ETFs for your core. If you prefer fewer execution choices, your main savings rate flows through a workplace plan, and you want native auto-invest with end-of-day NAV pricing, default to index mutual funds where your plan menu excels. If your life sits between those poles, mix them. Use mutual funds in the 401 key to capture the match and keep contributions automated. Then use ETFs in IRAs and taxable accounts where fractional shares, zero commissions, and tax efficiency shine. Here's a quick checklist before picking your winner. Confirm what you're actually buying, index methodology, top holdings, and rebalancing rules. Compare expense ratios between candidates. For ETFs, check typical spreads and tracking difference, and plan to use limit orders. For mutual funds, verify no loads or 12b1 fees, and confirm minimums. Match the choice to the account. ETF for taxable and IRAs often makes sense. Mutual fund for 401 menus is typically easiest. Tie everything to your contribution cadence and turn on dividend divided by interest reinvestment so every payout goes back to work. A brief callback to the last episodes. You learned why indexing wins quietly and how ETFs work in 60 seconds. This is the bridge from that foundation to a wrapper choice you can live with for years. The underlying asset mix still drives risk and return. The wrapper determines how easy and efficient your journey feels. Your goal isn't to optimize every basis point at the cost of discipline. It's to remove guesswork, lower friction, and keep your plan running through all kinds of markets. To close, make one choice today that future you won't need to revisit. If your account lineup and temperament point to ETFs, pick your core tickers, set a contribution schedule synced to payday, use limit orders for initial buys, and enable DRIP. If your situation points to mutual funds, set end-of-day auto-invest, capture the full employer match, and document simple rebalancing bands you'll follow annually. Either path works when it keeps you invested and keeps your decisions boring. Next, put the decision to work by building a starter ETF-based portfolio, 2 or 3 broad funds for total US. Stocks, international stocks, and high-quality bonds, sized to your risk tolerance, with fractional, calendar-based contributions, and clear rebalancing rules you can follow on autopilot. Bring your account types, your monthly dollar amount, and a short list of core ETFs, and get ready to lock in a paycheck-aligned plan you won't need to rethink every time markets move.